Hey everyone, and welcome back to the FishMarketAcademy, where we teach how to fish for gains. So in today's video, we'll explore how do you get paid in a bear market. So this is an introduction to GMX and CAP Finance. And if you found this video interesting and useful, do remember to like and subscribe, and let's get started. As usual, nothing I say is financial advice. So what is GMX? I don't actually know what the acronym stands for, but it's basically a decentralized spot and perpetual exchange, right? Similar to perps basically, and it supports low swap fees and no slippage with 30 times leverage on Arbitrum and Avalanche. So users can basically place market orders or limit orders on a GMX trading platform. So limit order is something that's pretty interesting to have, and there are multiple assets that are usually the blue chips like Bitcoin, Ethereum, and trading is supported by a multi-asset pool that earns liquidity provider fees from market making, swap fees, and leverage trading. So the pricing oracle uses Chainlink oracles with top pricing, so it's pretty safe. So what is GLP and what does it have to do with GMX? So GLP consists of an index of assets that's used for the swaps, and it can be minted and burnt with any index asset. So the index asset basically is part of the basket, and for Avalanche, it's basically your Bitcoin, your Ethereum, your AVAX, as well as some stablecoins. So the price for minting and redemption is calculated based on the total worth of the assets in the index, including the P&L of open positions divided by the GLP supply. It's basically 50% cash and 50% volatile asset, with the bulk of it being in Bitcoin. So it's a pretty stable asset that shouldn't fluctuate in price too much. So the most important part is that holding GLP earns you a profit when leveraged traders make a loss, and vice versa. So most traders actually do lose money on perpetual protocols, and the money that they lose goes to you. So in a bear market, there is still generally a lot of longs being opened, and a lot of them would get liquidated or lose money, and you earn a profit whenever they lose money. Although there are definitely traders that will be shorting in a bear market, the vast majority of people would still be longing, as the risk reward in long term for longing is pretty decent. But there are some people who will go on 30x leverage and then they'll just get liquidated time and again, and those liquidated funds would go to you as well. So that's how you make money during a bear market, by being on the opposite end of leverage traders. It doesn't necessarily have to be a bear market. It could just be a volatile and uncertain market that has a lot of spikes ups and spikes down, like what we're having right now as well. So the GLP index consists of these few assets. On the Arbitrum side, you'll notice that there is a more variety of DeFi protocols like Link and Uni. On the Avalanche side, it's a lot more straightforward. It's primarily just AVAX, BTC, Ethereum, and stablecoins. So the stablecoin percent adds up to be about 50%, and Bitcoin and Ethereum makes up the bulk of it, while AVAX makes up a smaller pool. So the price is more or less pretty stable, and it's something that is not very volatile in terms of its price movement, thanks to the basket of asset that it's made up of. On Arbitrum, it's also 50% in stablecoins, and the other 50% primarily is made of Ethereum and Bitcoin, with a small percent in Link and Uni. So the GLP index balances the weightage through the GLP minting fees. So what's unique is that it's not like a balancer pool where you get auto rebalancing, which means there is no impermanent loss. And how it works is that if an asset is above its targeted weight, the cost to mint GLP with that asset would be higher. And if the asset is below its targeted weight, the cost to mint GLP would be lower or even free. And this way, they basically avoid the impermanent loss mechanism and just go with a basket or like a ETF with targeted weightage approach. So if you look at the current weightage of BTC and ETH versus AVAX and MIM, you can see that Ethereum has a pretty high weightage right now, 25% out of the 20% it should be. So if you are using Ethereum to mint GLP on GMX, you will be paying a slight premium for it. So that's how they keep the other pools incentivized to be minted with those tokens. So GMX itself has a utility and governance token called GMX, and it also accrues 30% of the fees generated from swaps and leverage trades. And the GLP is a liquidity provider token of GMX, and it accrues 70% of all generated fees on the platform. Do note that you need to stake your GMX to earn rewards, but for GLP you can just hold it in your wallet and you will earn rewards directly. But the rewards need to be claimed, and it's not automatically to your wallet, of course. And if you're holding GLP, which is the more stable asset between the two, you do need to note that you get rewards in both AVAX and escrowed GMX rewards. So the bulk of it is in AVAX, which is liquid and you can just straight away take and sell. But your other reward, which is in escrowed GMX, does require you to vest for 1 year in order to sell it. So that's a pretty long time, and you can more or less just focus on the AVAX rewards if you want to get like more practical APR calculations. So if we take a look at the rewards, you can see that it's about 82% on Avalanche. This APR does change weekly, so if you're watching this video in the future, it might be a different number. And notice that the AVAX APR portion is 50%, which is the one that you will get immediately. And then the escrowed GMX APR is 30%, which you will get after 1 year of vesting if you want to sell your escrowed GMX. On Arbitrum, this is around 71% APR, which is still pretty decent, but Avalanche is higher and it's cheaper to use as well. For GMX, it's about 37%, and GMX is generally a more volatile asset because it's a governance asset and not a basket of tokens. GMX is a more volatile asset compared to GLP, so if you are looking to be a bit more risk off in a bearish environment, then GLP is probably much better choice due to the basket making up 50% of it in stablecoins. So what is escrow GMX or esGMX? It's basically the rewards given to long-term holders, and like I mentioned, you're claiming your escrow GMX will convert it into GMX, which are daily linear vested over a year. But actually it's not daily linear, you kind of vest it every single second, so it's actually not too bad, but it is over a year, so it's not very fast in terms of the vesting. You also receive multiplier points every second when you stake GMX at a fixed 100% APR. So these multiplier points essentially acts as more stake GMX, which gives you more stake GMX APR rewards. And staking GMX gives you AVAX and more GMX. So there's a bit of Ponzi-nomics involved. And just know that if you're not touching escrow GMX, you don't really have to care about this if you're just focusing on GLP. The mechanism is similar to Platypus PDP for those who are in that pool. Basically, in Platypus, when you stake PDP, you get more PDP, which gives you more staking reward. And likewise, when you remove it, you get penalty as well. So for your rewards, you can compound or you can claim them. Compounding will basically just take your pending multiplier points and escrow GMX, and then it basically just compounds and increases the amount of rewards you'll receive. Whereas claiming will initiate your 1 year daily linear vesting proportionate to the amount of GMX that you staked. Do note that your escrowed GMX tokens that are unstaked and deposited for vesting will not be earning additional rewards. So there's another protocol that is similar to GMX and it's called CAP Finance, and it's available on Arbitrum, and let's just review it briefly. So CAP Finance is similarly a decentralized trading protocol on Arbitrum, and it's actually up to 50 times leverage compared to 30 times leverage. So users can pool ETH or USDC to basically back traders' profits and receive a share of their traders' losses, or they can stake CAP to receive a share of the protocol revenue. So the price is determined based on a code provided by the Dark Oracle network. So it's not using Chainlink's top price oracle, but it should still be pretty accurate. So as you can see right now, the CAP pool mainly consists of ETH, USDC and CAP, and these pools pay out profits to traders and distribute a portion of the protocol revenue to CAP stakers. So as you can see, the projected yield for ETH is at 143%, which is really high for ETH. So people have basically been losing money during this entire downtrend because they have been longing. So if you are thinking that it's continued to be in a downtrend, you might want to put your ETH inside this pool, and if the traders keep longing and they keep losing, you get more rewards. And of course, likewise, the opposite is true. If the market starts to pick up and if traders are longing, you will start to lose your share. So just do take note. You do get additional rewards, which you can basically take back into this pool as well. So it's all in ETH and you are not touching any of the CAP protocol. So that's what I like about this. It's all native ETH tokens. For USDC, it's at 44%, but this is not very high. So I think if you want to still keep your ETH, which is basically like ultrasound money, earning 143% yield on ultrasound money sounds like a better deal than earning 44% on USDC, assuming you don't need to cash out your ETH anytime soon. But of course, 44% on USDC is still really attractive. So the difference between the two is that GMX is a more in-depth web app. GMX has more features like market orders, limit orders, and whereas CAP Finance is just market orders. But CAP does allow for more leverage, which is good for us that provide liquidity, because more leverage equals to more liquidation, which is good for the market maker, which is us in this case. What's cool about GMX is that it has GLP, which is the index of the assets, which acts kind of like stablecoin or a much safer asset during bearish period. And this differentiates GMX from CAP Finance because the GLP allows you to earn additional rewards on top of being exposed to stablecoins and blue chip assets. So in conclusion, GMX is well positioned to take advantage of the increase in trading activity we see in DeFi, and we can see their AUM and trading volume, they have been growing over time, and I feel that there is still a lot more room to grow for GMX or for CAP Finance as well, because they are currently capturing a very small percent of the DeFi margin trading volume, and it is likely that they can keep generating more value to token holders as volume increases, especially when we pick back up into bullish markets sometime in the future. What I like about GLP is that the rewards are paid in AVAX or ETH if you're on Arbitrum, plus the esGMX, and you're not just purely taking their native token of GMX, which users would just farm and dump. So this makes the rewards that you receive a lot more valuable and a lot more stable in terms of the APR. But at the end of the day, do remember to do your own research and invest with caution. Hope you guys found this video useful, and I'll see you guys again soon. Bye!
Baby fish do 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 do, baby fish do 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 do, baby fish do 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 do, baby